Let's jump right into this explainer and take a guided digital tour through the absolute massive transition happening in India's tax regime. If you've been following along since Budget 2026 was tabled on February 1st, 2026, you already know we're in the middle of a monumental shift. Today, we're using the official Income Tax Department e-filing portal as our map to figure out exactly what's changing, what isn't, and how you need to prep. Just a quick heads up before we dive in, the provisions we're looking at today are as introduced in the Finance Bill, so there might be a few minor refinements before final passage, but the core structure is definitely locked in. So, here's our roadmap for today. We'll kick things off with the big tax switch, then check out the new comparison tool, unpack some urgent updates you can't afford to miss, and finally wrap up with those all-important compliance deadlines.
All right, let's get into Section 1, the big tax switch.
Now here is a quick fact check for you, because what's really fascinating about this year's budget is actually what didn't happen. Everyone, and I mean everyone, was bracing for huge headline-grabbing adjustments to the tax slabs. But the reality? The headline tax slab numbers for assessment year 2026-27 remain entirely unchanged from the previous year. Literally no new slab rates. That lack of movement is itself the main story. Instead, the monumental shift is the historic replacement of the 6-decade-old Income Tax Act of 1961. We are officially rolling out the brand new Income Tax Act 2025, which fully kicks in on April 1, 2026. The government's ultimate goal here is just to drastically simplify the rules.
And honestly, a perfect example of this simplification is how we track time. If you've ever found yourself pulling your hair out trying to explain the difference between a previous year and an assessment year to someone, you can finally breathe a sigh of relief. The 2025 Act merges that confusing, old-school terminology into one incredibly straightforward concept. It's now just called the tax year. It's a brilliant structural change that completely cleans up the jargon and makes the timeline of your taxes make sense to the everyday filer.
Moving right along to Section 2, the new comparison tool.
To actually help professionals and regular taxpayers cross the bridge from the old law to the new one, the e-filing portal just added a seriously cool IT bill comparison tool sitting right there on the homepage. It lets you seamlessly map the old 1961 provisions directly to the new 2025 ones in just 3 simple steps. First, you select the 2 acts from the catalog. Next, you compare specific sections side by side to see exactly what shifted. And finally, you can export your findings straight to HTML or PDF. It's literally an essential digital lifesaver to help you understand how this new framework hits your specific financial situation.
Okay, let's pivot to Section 3, urgent nudge and updates.
If you're involved in the markets, pay close attention here. Share buybacks are now taxed as capital gains. This introduces an additional buyback tax that pushes the effective rate up to 22% for corporate promoters and a rather hefty 30% for non-corporate promoters. Also, if you're actively trading, you need to know that securities transaction tax, or STT, rates have increased, specifically hitting futures and options trading. So the cost of playing in those specific market areas has definitely gone up.
But hey, it's not all rate hikes. We actually have some fantastic relief measures for individuals when it comes to tax collected at source, or TCS. If you're sending money overseas under the liberalized remittance scheme for things like education or medical treatments, that TCS has been slashed from 5% all the way down to a flat 2%. On top of that, the TCS for overseas tour packages has been completely rationalized to a single 2% rate as well. So if you're funding international schooling or booking a vacation abroad, your upfront cash flow just got a whole lot better.
The portal is also heavily pushing a major new compliance initiative, the CBDT's second nudge, officially called FAST-DS 2026. This is the Foreign Assets of Small Taxpayers Disclosure Scheme. Basically, this is a massive, time-bound opportunity for small taxpayers who might be sitting on undisclosed foreign assets or income. The scheme lets you voluntarily declare them and get limited immunity from penalties and prosecution. It's essentially the government saying, look, come clean right now while the window is open, before the 2025 era fully locks in.
And if you dig just a bit deeper into the portal's update ticker, you'll spot a few more interesting Easter eggs. For starters, there's a nationwide verification crackdown happening right now, targeting restaurants that are suppressing their turnover figures. On the global stage, India and France just signed an amending protocol to their double taxation treaty. Plus, proving they are pretty serious about pricing certainty for businesses, the CBDT signed an impressive 219 advanced pricing agreements in the 2025-26 financial year. That is a ton of regulatory movement happening all at once.
Which brings us to our final stop, Section 4, upcoming compliance deadlines.
Before we get into the exact calendar dates, I really want you to ask yourself a question. Are your business operations, your accountants, and your software systems fully adapted to the portal's new infrastructure and the income tax rules of 2026? Because the digital rules of the game have changed, and as we'll see, the calendar doesn't wait for anyone to catch up.
Though, I will say, there is some genuinely excellent news on the compliance front. The government has introduced a much more relaxed timeline if you need to correct a mistake. Taxpayers now get a full 12 months from the end of the relevant tax year to file a revised return. That is a solid extension from the old 9-month window, which gives all of us just a bit more breathing room to make sure everything is perfectly accurate under the new regime.
However, if you look at the portal's new tax calendar, you'll see a seriously heavy cluster of deadlines hitting on July 14, 2026, specifically for the new 2026 rules. For example, government offices paying TDS or TCS without a challan, you need Form 13. Issuing a TDS certificate, you're using the new Form 132. Authorized dealers and IFSC units have to submit quarterly remittances on Forms 147 and 148, and stock exchanges must submit Form 1 for modified client codes. The rollout is officially here, so you absolutely must know which of these forms applies to you right now.
So, as we wrap up this explainer, I want to leave you with a thought to chew on. We are leaving behind a system we've known for over 60 years, moving to a streamlined, heavily simplified but entirely new framework. Sure, the tax slabs might not have changed, but the entire foundation underneath them has been rebuilt from the ground up. As the digital ink officially dries on the 1961 Act, is your strategy robust enough to actually thrive in the Income Tax Act 2025 era? I highly recommend taking some time this week to explore the portal, play with the comparison tools, and get your financial house in order. Thanks for joining me to unpack all of this, and stay focused out there.